Hey everybody, want to welcome you today for managing an options portfolio. It's Wednesday. We do this each week at this time, and grateful to see some familiar names in the chat. Glad you're here. I'm also grateful to be joined by Connie Hill, who's helping me out in the chat as well. So as you have questions, feel free to type those in the chat. Between Connie and myself, we'll do our best to get you helped out there. So let me just mention this. You can follow us on X at Brent Moore CS, at Connie Hill CS for additional content throughout the week. And there you go. Make sure you subscribe to the Trader Talks channel. Let me go through the disclosures real quick, then we'll get to our topic at hand. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Rolling strategies can entail additional transaction costs, including multiple contract fees. So that's something we deal with quite a bit in this webcast as we manage different options. A lot of them are multi-leg options. The material today is intended for general informational and educational purposes only. The paper money software application, that's the thinkorswim desktop software, that is what we will be using today, is for educational purposes only. And for the sake of simplicity, the examples in this presentation do not take into consideration commission or other transaction fees. All investment involves risk, including loss of principal. Past performance is no guarantee of future results. Let me head on over to the thinkorswim platform. This is the S&P 500. Hey, we've recovered. We were down a little bit at the market open, but we're now up. So, but I want to talk to you today about something specific. I want you to think about this. Envision this scenario. You have an options portfolio, you wake up, and you've been assigned early. I don't know if I mentioned that in the disclosures today, but let me emphasize this. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, okay? So this is a scenario that can certainly happen. What do you do in that circumstance if you've been assigned early? Do you do nothing? Do you exercise? Let's say you're a vertical spread and you have a long option and a short option. The short option is assigned early. Do you exercise the long option? Would it make sense to do that? Or do you sell the long option? What do you do? So that's what we're going to talk about today. But before we get too far into this, let me just kind of go through some basics, I guess. Remember, when you are an option trader, if you were buy the option, you have the right. If you sell the option, you have the obligation. What do I mean by that? What I mean is this. If you buy a long call, you have the right to exercise that contract at any time up to expiration and basically turn that into the right to buy stock. If you buy a put option, you have the right to sell stock, okay? You have the right. You choose the timing of that. If you are an option seller, though, you sell a call or sell a put, you have an obligation. In other words, somebody else decides when they want to exercise it, and you are assigned. And so if you're assigned and you have a short call, you end up selling stock. You're going to be short stock unless you already have stock to sell. And if you have a short put, you're going to end up buying stock. Doesn't matter if you already have stock, you'll end up buying more stock if you are assigned. You can be assigned early, but that is what we talk about when we're talking about assignment. So just the first couple points. One, exercise is the choice made by the option holder, the buyer of the option. Assignment is what happens to the short option after it's exercised, okay? You don't control the assignment when you're short, okay? And so after assignment, your account's going to reflect that. If you have a long call, excuse me, if you have a short call and you've been assigned, you're going to see negative 100 shares for a single contract in your account, short 100 shares in your account, and vice versa. Okay. Um, so there you go. Now, so that's assignment. What are the odds of assignment? Well, there are your odds of assignment go up. Number one, as you odds of early assignment go up as you get closer to expiration. Okay, you get closer to expiration, your odds go up. If it gets deep in the money, your odds of early assignment go up. Those are some universal things. Now, if you are a call, if you have a short call, if you have a dividend that's coming up in a stock, that increases the chance of early assignment as well. Okay? That increases the chance of early assignment as well. But in general, the formula is this. So we'll say dividend in the money, and not just in the money, but deep in the money. Okay, so I'll put deep in the money. And near expiry. Okay, and whether you're a call or a put, certainly these two are the biggest factor. And really what it comes down to is this, is if there's a lot of extrinsic value left in the option, your odds of early assignment go way down. Okay. If there's not much extrinsic value left in the option, then your odds of early assignment go up. Well, what's going to drive less extrinsic value? Well, the further in the money it goes, less intrinsic value. Okay. Excuse me, extrinsic value, less extrinsic value. As you get closer to expiration, that time value decays from the option, less extrinsic value. Your odds go up in that case. So now, something to realize, it's probably not the end of the world if you get assigned early. I think I saw Sam said he's had a half dozen short puts assigned in the previous few years. Yeah, it happens. And it can work out in your favor. It can work out against you. But you don't have this option anymore. You end up with stock, long stock or short stock in the case of if you had a short call. And then what happens at that point just depends on what that stock or short stock does in the future. You can kind of consider it a new trade at that point. Now, let me go here. Let's go through an example here. What I'm going to do is I'm going to just look at Lam Research. Now, I have not been assigned early. Paper money doesn't assign options early. That's the difference between the live account and the paper money account. Let's say, for example, though, that we did get assigned early on this trade right here. Okay. So what is this? This is a long put vertical. Excuse me. This is a long call vertical. This is a long call vertical. And the stock right now is at 393. So it's in the money. Odds of early assignment? Well, I mean, it's a little ways in the money, but we still have 23 days to go to expiration on that. So odds of early assignment would be less on this, but it's certainly could happen. And if we were assigned early, because we have a short call, okay, because we have a short call, we would end up selling stock. Do I have 100 shares of Lam Research to sell? No, I don't. So I'd end up with short stock. Now, if you ended up in a position where your account couldn't have 100 shares of short stock, then the broker could automatically exercise your long call to basically bring you to a zero position. But it's kind of a case-by-case basis on that situation. But the question is this, If we got assigned on this position, let's say we got assigned on this, we ended up with 100 short shares of Lam Research. What do we do with this? Should we exercise this contract right away? Well, let's go through that scenario here. And this will be kind of an example that we can use for others as well, other contracts. So if we were to exercise the contract, it would mean that we'd have the right to buy 100 shares of Lam Research at $360 a share. Right now, it's at $393 a share. In other words, that would be basically a $33 benefit to us. Okay, it's at the stock or we could buy it at 360. The current price is at 393. We'll say 30. It's going to bounce around a little bit, but that's I got to pick something here. So if we exercise it, we could buy for $360. Okay. And currently it's 393.3. Okay. So I'll just, to make it nice and neat, I'm going to put down a little dollar sign next to those. Okay. So what's our benefit? Our benefit is $33.30 benefit. Okay. That's great. All right. What if we don't exercise? What if instead we decide just to sell the contract? Well, how much is this contract worth right now? The current contract, the current long contract, is worth about $52. Okay? It's worth about $52. So we could sell this for $52. I'm not factoring in commissions right now, but the benefit is a $52 gain on this. Okay? So do you see why exercising, in this case at least, would not make sense? You benefit more if you just sell the long contract versus if you exercise the long contract. Why is that? Well, let's go and let's look at that just a little bit more closely. Let me move this out of the way. Let me get rid of my little drawing there. Clear that. And let's look at LRCX. So here's LR. Let me try that again. Here's LRCX. Let's look at our contracts. And what I want to do here is, this is the contract we're talking about. This is the long contract that we could potentially sell. It's at about $52, which is the mid price here on these. And what I'm going to do is I'm going to switch this, and I'm going to put this in as I'm going to put in extrinsic value here. Do you see the extrinsic value on this contract? This is the surplus. This is the amount in addition to the just pure amount that it's in the money that this contract is worth. If you were to sign it, if you were to exercise this contract and you held the long contract, you'd be giving that up essentially. You'd be giving up the extrinsic value. So it really wouldn't make that much sense for most holders of long calls in this case to exercise that contract here. As the extrinsic value goes down, it may make more sense. As the extrinsic value gets down closer to zero, then it may make more sense for them to exercise. But in this case, it wouldn't make any sense on this. So what would you do in this case on Lam Research if we were assigned early? Well, the answer is this, is you could decide, I'm just going to stick with short stock in this case, But that's a totally different trade than what we're doing with different risks. If you're short, if you just have short stock, you have a theoretical unlimited risk on that trade. Okay. So normally you'd look to buy that back. How can you fund to buy it back? Well, normally what I think a lot of traders would do is they'd sell the long call, use that money, and buy back the short stock there on that. Okay. All right. So I'm hoping that makes sense. Now, let me go through, and we got some questions here. Let me just make sure. Now, if you are assigned, could process on the assignment and exercise if you're in a live account. If this were a live account and it were to happen, here's what would happen is you'd be looking at your account probably, and you'd see this, and what you would see is it would say Nick Lamb Research minus 100 right here. That, and this would be gone, or it may show, but it shows zero. Okay, when you first see that, that's what you would see there. Okay, that's what you would see there. Now, that's from the option seller standpoint. Let's say you did want to exercise a contract early. You can click on it. There's exercise right there on that. But this is typically not the best scenario when there's extrinsic value on those contracts, which in most cases that's what you're going to see. Okay, I'm hoping that's making sense there. And so it can be, we're going to put here in a second. I just use this call because I think this kind of illustrated some things there. It's slightly different than the puts there. You'd end up with short stock, and we weren't assigned early, but that's the process there, Charles. Is it just happens. Why does it happen? Because as the option seller, you don't see it, but the option buyer, somebody out there whom you don't know, decides, hey, I'm going to exercise this contract, maybe some institution, and it gets sent to the options clearing corp, and they say to Schwab or whatever broker is, hey, we need someone's exercising it, and they randomly assign it. Okay, and so you get assigned. You have no choice in the matter. Okay, so that's that. Let's look at another example, and this example is let's see. I don't think I have any short. Hold on one sec. I got to remember what I let's see. I just jotted down what I was going to look at, and I got to remember I had some puts. I had short puts for KO. I don't have anything there. Do I have any? I thought Oh, there we go. It was just shrunk down. There we go. Okay, so here is KO. Again, we haven't been assigned early, but these are puts. So what do we have here? We have different strikes, same expiration. This is just a short, this is a short put vertical spread right here. Okay, so could this be assigned early? Yes, any option could be assigned early. I have short contracts here. Would it make sense in this case, let's say we were assigned early, what would happen to our account if we were assigned this short put early? Well, the first thing we would know is we'd probably see this short put would be a 0. Because I have 2 contracts, what we'd see is plus 200 shares of Coke stock if we had that. Now, let me get rid of that. And let's talk about the long put here. So what's the benefit if we were to, what would happen here with this long put if we decide to exercise the long put to cover our position? Well, this gives us the right to sell our stock at 78. This gives us the right to sell stock at 78. And the current price is 81. Would it make any sense to sell stock at 78 if the current stock is 81? No, it wouldn't. And that's partially because these are out of the money right now. Even if it's in the money, we're still going to have that same extrinsic value situation that we hit in the other case. Let me pull up Coke here on this trade tab. Let's look at KO. And here's the contract that we have that we could potentially assign. And remember, this would give us the right to sell the stock at 78 when the stock's at 81. That wouldn't make sense. But let's say we were in the money here. Okay. Let's say we were in the money here and the stock was at 84. That would give us the right to sell the stock at 84, even though the stock's at 81. Well, that's great because that would mean it'd give us about a $240 or $2.40 difference per contract. But remember, we still have that extrinsic value. We could still sell it for more than that if we just sell the contract. So in the same case, so it's the same situation as before. It doesn't benefit us to exercise that other contract in this case. In this case, the typical scenario, if you were assigned early, would be to just sell the put and exit the contract there. Okay? So I don't want to belabor that, but that's how that works. I'm hoping that makes sense for everybody. If you have any questions, let me know on that. But that's the Coke trade there. And that's how we would manage that trade probably there. Now, let's go and let's look at some different types of trades and talk about management of those trades because, hey, look, we have not actually been assigned early on these. But let me start. Last week, we didn't get to any calendars. In fact, it's been a couple weeks, I think, maybe 2 or 3 weeks since we've gotten to calendar spreads or butterflies. So I want to make sure I get to those today before I run out of time. So I'm going to start with calendars, diagonals, and butterflies today. Okay? So let's start with BSX. Again, if you have any questions, feel free to chime in there on this. So I have Boston Scientific. This is a diagonal spread. How do I know it's a diagonal spread? Because I have different strike prices, 45, 47. Okay. 45 and 47. And I have different expiration dates, July 2nd and July 17th. That is a diagonal spread. And Chris said, use profits from the short put vertical to offset the cost of the, but yeah, that's kind of, to summarize, I guess, our previous point. Instead of exercising, use the profits from selling the long contract to buy, to fund, buying back your other position there or whatever. So that's how that works. Let's go. And so what do we do? Well, we only have 1 day to go to expiration. So we got to do something on this. We could close out of the whole shebang here if we wanted to. That's no problem. Or we could potentially roll this. So right now, one of these, this is done July 2nd. Okay, that's tomorrow. Markets aren't open on the 3rd, so we have an early expiration this week. And this is July 17th. Now, if this were July 9th, practically there's no intermediate roll position we could do on those. If we were to roll this out to the next date, and the next date were the same date as this date, it doesn't work. It just closes out the position. That wouldn't make any sense on that position. It wouldn't be a diagonal spread anymore because we'd have the same date on this. In this case, though, what we have is could potentially roll this out to, say, July 9th or 10th or whenever I guess 10th is probably when the next expiration would be. So we'll look at that. We could look to roll. But do we want to? What do we want on this trade? So when you're trying to decide what you want on this trade, I think it is beneficial to use the Analyze tab. If we go to the Analyze tab and pull up BSX, we can see the position we're at right now. Here's the current price, around $43, okay? $43. And we're actually in a pretty good position as it now stands. And we could look to roll this out. So let's go and let's look at our possibilities on rolling this. What we're probably going to do is we're probably going to look to roll this out of the money, sell, bring in some premium on this, and hope that just kind of expires worthless. So here's what we're going to do. I'm going to go to BSX on my trade tab. Let's look at our existing position. Here's our existing position right there, that 45. If we were to exit that, which currently, I don't need this many strikes. Let me do this. Which currently is roughly 200. We have a short position here, so a little more than that, 210. 220 would be more close to the mid price. So we could roll this out to the 9th. And we could look and we could go and look to sell a contract. And for this, what we may do is we may decide to look at the delta and roll it out to, say, the $42 contract, maybe something like that. That would bring in about 50, if we go to the mid price, $55, maybe $50 of premium that more than likely is going to expire worthless. Don't know for sure. Our delta is 33 on this, okay? Our delta is 33. Delta tells us how much the option is going to move in relation to a $1 move in the stock price, but it also gives us a proxy for the probability of it expiring the money. If it expires out of the money, it expires worthless. Worthless may not sound good, but actually in this situation, it'd be okay, because what that would mean is the thing we sell for $50 or maybe a little bit more, we wouldn't have to buy it back at all at that point. Okay. So we have a couple choices. We could just buy back the existing contract and sell a new one, or we could do them all in one order ticket. And that's what we call rolling, doing it all in one order ticket. It doesn't save you on commissions, rolling, by the way. You still got to do the trade. You still got to pay the commissions on this. I'm going to right click on this and I'm going to create a rolling order. Now we already looked at the date we wanted to do. So I'm going to click on this create a rolling order. And it actually, in this case, it got it right. Normally, you'll probably have to tweak the expiration date. But this is our current contract, July 2nd. It rolled to the next available contract, which was July 10th, which often that's not going to know to do that. So you just got to double check that and change that. You can just click on it to change it if you want. But what we're going to do is we're going to make this the $42 strike, okay? And I'm going to confirm and send. It's two contracts, by the way. That's the mid price. Probably won't get filled exactly at the mid price, but I'm going to do this. I'm I'm going to confirm and send, and I'm going to send that order. Okay. So I chose the 42. In this case, the 42 our delta was 33. If you do the 43, that's kind of like right at the money because the stock's right around 43. So it's basically, 50-50, so to speak, whether we're going to be in the money or out of the money at expiration. And generally, when we're doing these short contracts, we want them out of the money. Time decay helps us on those. So effectively, what we've done is we've just kind of, when you roll, this is what it looks like. The old contract that you had right here is going to show 0, okay? Because we don't have that anymore. Here's our new contract. And now, if you just look at this, it looks like, hey, you just had this diagonal spread right here. We rolled that. This is going to be a positive theta trade. Here's our positive theta. Here's the negative theta. The net theta is roughly $7 to the positive. That means $7 a day, everything else being equal, is benefiting us. Now, if the trade goes against us, that $7 a day in time decay probably isn't going to make up for that. But everything else being equal, that's $7 a day of time decay of theta that we're going to bring in there. And now we can also now look at the Analyze tab and look at BSX and see kind of where we now stand on this. This is for the new trade. Let me just go up here, make sure we don't have anything else in there. Yeah, this is just showing the new trade right here. And you can see the current price, $43. Our time decay, $7. It's a bearish trade, but we're right down here. It can go up a little bit and we'll still be okay. Okay. Go up a little bit. If it goes up too much, that's no good. If it goes down, that's great. Okay. So that's BSX. Let's move on. Let's go to Carvana. Okay. What do we have here on Carvana? Carvana, we've got a butterfly spread, but it's a skewed butterfly. We have a bigger distance between our calls, this call and this, a $2 difference on this side, $3 difference, 66 to 69 on this side. So it's a skewed butterfly on this. Let's take a look. And this is the kind of trade, skewed butterfly. Some trades you look at and you know exactly what you need them to do. Okay. A normal butterfly is pretty straightforward because you want it to go to the middle strike price. Skewed butterflies, diagonal spreads would fall in that category. It can be a little more confusing. So that's in a case like that. I think if you look at the Analyze tab, it can be beneficial. Here's Carvana. Where's the stock right now? Right now, it's here. This is a losing position if we're at right now, where we're at right now. If it just stays where it's at, that's no good. It's just going to get worse. The purple line shows where we're at right now. The blue line shows where we're at expiration. It just gets worse and worse on that. Okay. So now, if we think the stock's going to go here, great. Okay. So are we very bearish on Carvana would be the question on that. Well, let's look at Carvana, CVNA. And I'd have to say, no, from a technical standpoint, number one, we probably have some decent support here in this level. Okay. Decent support in this level. It could bounce down off the moving average, as Lauren said. That could happen. But right now, I'm not overly convinced of the bearish case on this. Let's look back at the stock here. 16 days to go. Somehow, we're actually profitable on this right now. I don't know why, because if I just looked at this, I'd say, and where it's going to end up, I'd be a little surprised that we're profitable on this. Okay. And let's go. And so I'm just going to close out of this. Does that make sense why we're closing out? when you're deciding whether to roll or stay put or close, consider where we're at right now, where you think the stock's going to be, and what the situation is if the stock doesn't go where you want it to go. I'm not super bullish. Right now, we're in good shape. We're actually making money on it. For some reason, we're making money, even though the stock really hasn't gone our way. I'm going to take the small profit and get out of this trade. Now, in the disclosures at the beginning of the webcast, we said multiple leg option contracts have multiple commissions, fees, right? Well, how many legs do we have here? We've got 8 legs here. So there'll be commissions on this that are going to factor into this, but I'm going to get out of this trade. And I'm going to right click. Now you can get out all at once if you want. You can get out a few legs at a time if you want. If I want to get out of these the short calls, I can create a closing order, buy the short calls back, and see if we can get a little better price on those. Confirm and send those. Okay. And then what I can do is I can go back and I could buy the long calls. I can create a closing order, sell, and sell. Why am I doing these separately? Because if you have a multi-leg option contract, you got to find a buyer who is willing to do all the legs there. And that's probably, so I'd say it's probably less likely to get as good a price on that. So I'm going to just kind of do these piecemeal in a way and get out of this trade. And there we go. So we're out of that trade. There we go. Let's keep on moving down. We got KMI. KMI, we're down a little bit on this. This is a butterfly. Okay, this is a butterfly spread. Selling 2 of the middle strike. Bought 1 higher, bought 1 lower. Equidistant. When we have an equidistant butterfly, we want the stock to go to the middle strike. Well, it's 31. So we're slightly bullish on this. We'd like this current stock price, which is at 31.70, to go up to 33. We got 16 days to go. There's no urgency to get out on this, but we are a little bullish. What are the prospects of a bullish bounce on this? Okay, so here we're kind of pulling in our technical analysis. Here's KMI. Hey, KMI, we've got, hold on. We've got some support down here. It could get worse, but it's gone up and down. I could see this going up a little bit. So I'm going to give this a little bit of time on this and let this run here. Okay. So comments in the chats. Trader Joe said, butterflies are not my thing. I haven't seen many gains on those. I'm more for directional trades. That is one reason, by the way, you'll notice in this webcast, in the managing in the advanced options webcast that I teach on Fridays, probably more often than not, when I'm doing butterflies, I end up skewing them to make them a little bit more directional than just the traditional butterfly spread on that. Okay, so that's one reason traders sometimes will skew those butterfly spreads there if you're not a fan of the traditional butterfly spread. Okay, what do we have here? A different type of trade. What's this? Same strike, different expiration. This is a calendar spread. Once we get under about 10 days, about a week or so, typically we're looking to roll these. And we want the stock to stay around 72 in this. In the case of a butterfly spread, you want it to be at the middle strike. In the case of a calendar spread, you only have 1 strike. This is the strike you want it to be at. So we want the stock to go to 72. Well, right now it's at 72. Do we think it's still going to be at 72 going forward? Well, let's take a look at MO here on this. Okay. Here's MO. So this is our goal right there. I just put a little line there on this. If you see this as a possibility of staying kind of in this area, you can look to roll it. You can close it as well. Wouldn't be much of a gain, but it'd be something small maybe. Or we could roll this. It's 9 days here. Now, do we have to roll it to a 72? No, we'd roll it to 72 if we think it's going to stay at 72. If we think we could diagonalize it, what do I mean by that? What I mean by that is you could say, well, I think there's some upward pressure on this. Yes, we kind of had this thing going here where maybe it's that, but in general, maybe I'm a little bit more bullish than neutral on this. And in that case, when I roll it, maybe I don't keep it at a 72. Maybe I sell it a 73 or a 74 and diagonalize that. Yes, you can do that. So let's look at Altria. Let me go here. Here's the short contract. We could roll out a week. See what we got. 73, 74. And so we're looking at a 74 call if we wanted to, or a 73 call to make it a little bit more bullish. Let me go right here. And just look, here's our delta, about a 40 delta on the 73. I'm going to look to sell the 73 July 17th. So I'm going to click on this. I'm going to right click on it. I'm going to roll it. Create a rolling order. Again, in this case, it actually picked the right date. It's not always going to do that, so make sure you double check the date that you're rolling to. That's why before I roll, I don't just right click on it and click, oh, I want to roll this. Make sure you know the strike and the expiration date that you're going to do on that. And this will diagonalize that trade. Okay. Let me confirm and send. And I'm going to send that trade. And hasn't filled yet. Let me get rid of this. This is what it's going to look like right now because it hasn't filled. This is showing 0 because it hasn't filled. This is the one we're trying to roll out of. It's still showing -2 because it hasn't filled. A buy order in and a sell order in. Okay, so that trade, we'll see if that fills or not. Okay. And let me go, and now we're just about out of time. There's one other thing I wanted to show you today, and that is a mess up from last week. I found out right after our session last week. I'm trying to think whether it was this webcast or it was my advanced, oh no, I was out on advanced options. So it was this webcast last week. On Micron, I meant to do a vertical spread. Someone, I forgot, I'd like to give you credit by name, but I forgot exactly your name, pointed out in the comments on the class, hey, you didn't do a vertical spread, Brent. You made it a diagonal. I didn't mean to do it, make it a diagonal. I meant to have my strikes, my expiration dates the same, both July 24th. Somehow I ended up with a July 2nd. I messed that up. You can see this is a disastrous trade. I was going to get out that day, but I thought, hey, I wanted to point out to you just as a lesson learned, and it's just gotten worse. Be careful when you're doing trades. Sometimes I rush through these in this webcast just to try and get through more, but you do need to be careful when you place your trades because this one, I rushed it. I didn't do the vertical spread, which in this case, it was going to be a long put vertical on Micron, which would have been working out probably fairly nicely right now. But in this case, not so much. I'm just going to have to get out of that trade there. Okay. So there we go. Now, question was, when I say skew on a butterfly, what I mean by a skew on a butterfly, let's say we have a 50, 55, and 45 butterfly. That would be a traditional butterfly. Skewing the butterfly would be like doing a 60, 50, 45. The width between this and this is different than the width between this and this. That's what we mean by that. Okay. A broken wing, yes, broken wing butterfly, correct. Same thing, same thing. Okay. Hey, everybody. Thank you for joining me today. We talked about early assignment today. It can happen. Short options are always subject to early assignment. What do you do in that case? Well, we spent a fair amount of time talking about the difference between exercising or just selling like the long contract there. And so there you go. We also managed a whole bunch of different positions, calendars and diagonals and butterflies. And I appreciate you. I hope you all have a wonderful rest of the day and a nice holiday weekend, by the way. Markets are closed Friday. We'll see you all same time next week. Bye-bye.